Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So start with the Australian dollar versus the Aussie. Back in July when we were doing this webinar on the 29th, here was our picture of the dollar in the little trading range down between 104 and about 107. So during the time it's in this trading range, what we do is we trade the trading range from the bottom to the top as long as prices are going sideways, but we always want to prepare for a possible breakout in one direction or another. And if I break out, I usually go in the direction of the breakout. If I break out through the top, I'm going to begin a new uptrend at this point. If I break out through the bottom, I'm going to continue the downtrend. If I break out to the upside, I should find support at 107. If I break down below 104 and rally back up there, I should find resistance at that point. So at this point, we said the Aussie broke out of the bottom of the initial 104-107 weekly range and made a new 52-week low at 104 or 101.50. So in order to take advantage of this, if you were using spot or futures, a 250 pip move against you would have stopped you out of the trade before the trade really got going in the opposite direction. By using your ISE FX options for a position or as protection, you could have been able to participate in the rally. So what am I saying here? Well, what happened is we extended that initial 104, 107 range down all the way to 101.50. So that means that before we went to 165, we actually went all the way down to 101.50. So without options for protection or as a position, you could have blown your Forex account before the move. So we did have that push down out of the bottom of the range and then the breakout through the top. And of course, that's probably happened to a few traders in this room, right? Where you get stopped out right before the price moves in your favor. So as we were moving higher, we were, of course, moving higher, basing and moving higher again. And this is what we mean by almost a straight up parabolic move. Some of the fundamental reasons for this, obviously, were safe haven, credit markets seizing up. Here's a good one that I found out at a later date. All U.S. corporations had a chance to repatriate their dollars and receive a 35% tax bracket if they got it done by December 31st last year. So it's pretty hard to know all these fundamental things, but of course your chart kind of helps you to stay on the right side of the market, because at this point you don't want to be trying to short this runaway freight train. Okay. We talked about placing stop losses by using the 38 or the 23 fib. So we could place our protection below the 38 or the 23 fib by a put just to protect our position. And we also talked about what happened when we got up here in the beginning part of November. We actually got all the way to the highs in November, and so we had gone a tremendous 61% move higher in just a very, very short period of time and almost straight up. So at that point in time, we said in November that we need to protect ourselves just in case the price breaks out of there. And the other thing is due to the size of that tremendous trading range, as big as it was, between 142 and about 165, there was a chance that we could actually play that trading range while it stayed inside that range. We were talking about at that time that our 30-weighted moving average was lagging behind. Was lagging behind so far that we would actually use a faster 10-period moving average to decide on where to place protection. And so at that point, we said the best thing to do would be probably to buy a 140 put to lock in the profits from your original entry if you still had your position. Well, here we fast forward to 129 now, and we're looking at, we're still inside this range. But I want you to notice that we've extended the bottom of the range down to 138 from 142, but we never were able to make a new high. And now we were starting to form a pattern called possibly a descending triangle at this point at the end of January this year. When we look at where we are at the end of February, the triangle that was a descending triangle has now become an ascending triangle, so we call that a symmetrical triangle. So when you've got higher lows and higher highs plus lower highs and lower lows inside of a triangle, it becomes symmetrical. The point is we're still inside this range at this point at between 138 and 165. So since November, we've been range bound. We did not make a new high on the Aussie, but we did extend the range lower, and that's exactly what I like to call it. I call it range extension. And now the thing about the symmetrical triangle that we're looking at is normally it's an indecision pattern. But even on the weekly chart, it looks like we want to break out to the upside and retest the prior highs. But notice I also said the size of the range down here still suggests a possible distribution phase. When those ranges get as big as you see these ranges here, that's usually what a stage 3 top looks like. So how can we come up with some clues that may be able to tell us what to do next? What I usually like to do then is drop down to the next time frame below the weekly chart, which is the daily chart. Weekly charts are great for analyzing trends, but they're not as sensitive to changes as the daily chart for spotting changes in the trader's sentiments. So in other words, many daily chart patterns will form during the week, which you won't be able to see on a weekly chart, but you will be able to see them on a daily chart, and some of them will suggest continuation or possible reversal going on inside that range. So a trading range that forms after a big move up in price can also be a higher accumulation phase if we break out to the top of the range and we make new highs. So we don't want to limit the possibility that this thing is going to head lower. And in this case, inside the daily Aussie chart, the dollar versus the Aussie was actually making what we call a cup and handle pattern. Now you'll look at this cup and handle pattern, and some people will say, well, that looks like a cup and handle. And some other people will say, well, it really doesn't look like a cup and handle. Bottom line, though, on this pattern, we did base for a long period of time after a big move up in price. And we also started to be able to draw a trend line here indicating that even though sellers are pushing prices down, people are paying higher and higher prices. So even if you don't see that cup and handle pattern, and to me it looks like a cup and handle because it looks like the little teacup I drank when I was in London teaching this course. So when it comes to chart patterns, there's no perfect chart pattern. It's a little bit subjective. So when we see this cup and handle pattern forming during the month of February, it suggests higher prices for the dollar versus the Australian. But notice I say here, use caution entering any kind of new long position after such a large move up in price, because what will happen is the higher you go up, the more likely the later in the trend you are, and the later in the trend you are, the more likely you're going to find that reversal point. If you do take the trade by taking a trend line touch, you want to make sure you're taking partial profits back up at the prior highs. And of course, if your trend line starts to get steeper, if the angle to this move were to get steeper, you'd want to draw a steeper trend line just to be on the safe side at this point. So our British pound was the next one we had here, and again, some kind of income strategy while it was in the initial trading range was a suggestion back in June and July. But of course, if we're going to break out, we want to switch up to some kind of a trend following strategy. We broke out again in the month of August. We based for a while at some higher prices. We actually started to form gaps. Now, we very rarely see gaps. If we see gaps, it's usually there's a couple of types of gaps that you could see. You could see what we call a novice gap or a professional gap, and I'll explain the difference between the two. Okay.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.